Good morning. Welcome to the Genghis Weekly Investor Briefing. My name is Daniel Ogeto. I'll be your host today. And today our panelists include our head of research, who is Churchill Ogutu. Today, our analyst, Gerald Morioki is away on leave, so Churchill will be taking us through. Over to you, Churchill.
Thank you, Dan, and please enable me to share my screen.
Yes. You're good to go, Churchill.
Thank you. Good morning, everyone. I'll take you through this week's investor briefing. I'll start with the macroeconomic development, and then I'll go into equity, and then I'll get into the fixed income segment. So just starting with the macroeconomic review, last week you had two major reports, or rather three of them. The first one was the second quarter unemployment report, which came out on Monday. Basically, just this slide shows what changed between the first quarter and the second quarter. In terms of the population that is tracked to be considered in the labor matrix is between ages 15 years to 64 years. And there was an increase of 178,000 of that. And then we have labor force. So basically, the labor force comprises those people who are employed and the unemployed. So overall, that number declined by 836,000. And the inactive population, so inactive population are either those people who are informed or other people who are above, people who are not in the working age years, so between ages 15 up to 18, and those people who either had been retrenched or people who have lost their jobs or people whose businesses were not operating optimally during that period. So that number increased by 1 million from 8.7 in the first quarter. So ideally, we have some other metrics that are tracked. So there's the labor force participation. That is now the labor force of as a percentage of the population. So that was 64.4%. We have the employed people who are employed of as a percentage of the population ratio. So that's 15.8 million people who were employed as at the end of in the second quarter period, over 27.5 million people who are aged between 15 years to 64. And that's where we got the unemployment rate, which was 10.4%. Basically, the unemployed, 1.8 million people, and the labor force, which is 17.7 million people. That took us to 10.4%, which was a double of what was then as in the first quarter period, 5.2%. Just looking at these numbers specifically, in terms of the increase in people who are aged between 15 years to 64 years, that was an increase, a net increase of 178,641, as stated earlier. And that basically is comprising of people who are in the labor force in that population and those people who are inactive. So the people who are not in the labor force, people who are in the labor force, that number declined by 836,000, and the inactive population went up by 1 million. So the sum of that came to 178,000. So just looking at the employed people, that really stood out even in the news flow that was there last week in the highlights of this data, that 1.7 million people who were employed as at the first quarter period had lost their jobs by the second quarter period, 1.7 million. So ideally, you find that some of them, the 1.7 million, some of them are considered unemployed. You've lost your job, but you're actively seeking for that job that you've lost. So that's increased by 880,000. And then there are people who perhaps they had lost their jobs, and perhaps there's no opportunities for them to look for new, better prospects. So that number, those people are considered under the inactive population, and that number went up by 1 million. So just summing the unemployed, the increase in unemployed at 80 million, at 80,000, and then the 1 million people, you find that, and then you reduce the increase of people who entered into the population age between 15 years to 64. That is the number that gave us 1.7 million. It's a bit technical, but that's the math behind it. So getting on to other reports that came out last week, we had the inflation for the month of August. The overall inflation went down from 4.59% to 4.36% in the month of August. And ideally, we've seen that there's been a decline in inflation between April all the way to August on a month-on-month comparison has been gradually declining. And the technical term for that is called disinflation trend. Core inflation went up slightly from 1.6% that was there in the month of July to 1.9% in the month of August, which was the review month. Food inflation at 5.4%, and in line with the expectation, fuel inflation edged up to 10.7%, just basically mirroring what we've seen with the latest Energy, Petroleum, and Regulatory Authority price review in the last period, which was coinciding with the August inflation review period, 10.7%. That was the quarter. So this, of course, just ties in as investors. Perhaps you are trying to look at where is T-bills a good investment option? Is it money market fund? So as investors, you can also check in where is the inflation so as to look at the real return. Right now, inflation is at 4.4%. So if you are getting a yield or a return of say 10.4%, that real return is 6.6%. So that's where investors and inflation comes into play. The August PMI index that came to 53%, 53, down from 54.2. With this PMI, any number above 50 shows that there's an expansion in activity. Any number below 50 shows that there's contraction in activity. So at 53, there was definitely an expansion, but remember that you're coming from a low base, particularly in the second quarter period. That period was between April to June, whereby the average was around 39.7. So that is where we are coming from. It's not translating that there's a robust business sentiment among the private sector, no, but it's just from the point that we are coming from a low base, that's where we're seeing these numbers. But we're still not yet out of the woods in terms of private sector business sentiment. Moving on to the equity segment, just to take you through what happened last week. Nairobi All Share Index went up by 0.4% to 139.27. We have the NSE 20 share benchmark index that went up by 3.4% to 1,855 points. In terms of turnover, in the week, edged up by 8.6% to 2.96 billion. Foreigners' participation was 60.7%, roughly 1.79 billion. So that was 60.7% of that, with net inflows from foreigners around 642.5 million. We've seen that there's been a second week running that there's an outsized inflows into Safaricom, in particularly second week running, which somehow distorts these inflows numbers from the foreigners. And also equities also followed in tow in terms of inflows by foreigners. Outflows was on KCB, EABL, and Cooperative Bank. And we're likely to see that this trend might even continue in the course of this week. Moving on to where NSE is against African peers. And basically, as foreign investors, where they're sitting at, they look at Africa as one big basket, and they keep track of where they want to invest into based on the Morgan Stanley Composite Index, or rather the MSCI. That also dictates where they want to move. And looking at some of the metrics that we have that we keep track on, in terms of the year-to-date performance, the Kenyan benchmark, that is the Nairobi NSE All Share Index, has declined by 16.6%, which is larger than the average in the African markets, which is 13.6% decline. Price to equity. So this is a relative measure whereby looking at what is the average, what is the price, what is that NSE index as a percentage of the earnings of all the holdings in that index. So that metric, price to index to price to earnings ratio, is 9.3 times. And looking at the African average, that is 13.1%. So as a rule of thumb, anything, if you look at say our Kenyan metric is at 9.3 and the African average is at 13.1%, 13.1 times. So ours is lower than that. So it's at a discount if you look at it from that metric. And dividend yield. So when I talk about the dividend yield, is the dividend that is paid out by the underlying companies as a percentage of the price or the index at that point. So for the Kenyan is 5.4%, which is higher than the 4.6%, the average offered by the all African peers that we keep track on. So those two metrics are quite attractive even by foreigners, as they just sit behind their desk and then they just do like a run through of which market they want to invest into. You find that Kenya is attractive just based on those two metrics, price to earnings and also the dividend yield. So that's where the previous slide that I pointed out, where Safaricom and Equity has attracted some increased inflows, that could also be a measure of what even the Kenyan benchmark index compares with the African peers at any given point. So as I move quickly to the corporate actions, basically I'll focus on book closure dates. And this Friday is the book closure for Jubilee Insurance. It announced a 1 shilling interim dividend, and book closure is this Friday. And it had a dividend yield. The previous dividend yield was around 3%. So it had announced final dividends based on the last financial years of 8 shillings per share, and vis-a-vis the price, which is around 220.5, that gave us a dividend yield of 3.6%. So right now we have an interim dividend of 1 shillings, which the book closure this Friday. Next month we have Centum announcing 1 shilling 20 cents final dividend, book closure on the 2nd of October. Later on is Kenya Re announcing 10 cents final dividend, book closure on the 9th of October. And finally Kengen, which last week announced its full year earnings for 2019, which was pending, just waiting for the Auditor General sign-off. And it announced 25 cents final dividend with the book closure on the 22nd of October. Just to note is that this dividend payout, it traditionally has been paying roughly 33% dividend payout. So basically the percentage of dividend that they are paying back to shareholders as a percentage of the income, net income that they receive, traditionally has been 33%. But if you look at the 25 cents that it announced, that's roughly 21% dividend payout out of the net income that was there in 2019 full year. Moving on to our equities trading ideas for the week. Majorly just the theme that we have, and based on the third quarter equity investment strategy. We are biased in terms of our recommendation to those stocks which have strong buffers. Right now, we know that we are amidst the COVID-19 pandemic, so we are really strong on those counters that have buffers to ride through the storm of COVID-19. But specifically for this week, we have buys on KCB and Equity Group. Right now, we are seeing attractive entry levels, 36.75. That was the last closing price on KCB. Equity closed at 35.85 last week. They are attractive entry levels. If you look at some point that around February, these counters were around 55 shillings to 56 shillings level. So this current prices are attractive entry prices. We also look at the return on equity, basically net income of these two banks as a percentage of the equity shareholder funds. So for KCB, that metric is 12.1%. For equity, that's 16%. And if you compare with the whole banking sector, it's around 10.5%. So there's a premium in terms of return on equity that is offered by these two banks. We have what we call out of consensus trade recommendation. And for this week, we have accumulate on capacity for investors who are looking for long-term value. The price closed at 8 shillings, which is below the net cash per share of 8 shillings and 4 cents. NCP, basically net cash per share, is cash, government and corporate bonds, and equity securities. So people who are looking for long-term value might consider accumulating on capacity counter. Let me move to the fixed income review. Last week, in terms of secondary market activity, we saw a surge in terms of the week-on-week activity, which went up by close to 32% to 32.3 billion. Most of the bonds that were traded last week were on the primary bond that was issued last month, that is IFB1 2020-11, the 11-year infrastructure bond. And also there's a 9-year infrastructure bond that was issued sometime in April this year. Those two bonds were the ones which took the lion's share of the week's activity. In terms of weekly tables, the auction results that came out, 11.9 billion was the bids that was offered by investors. So that is a performance rate of 49.6%. We've seen that the last 4 weeks, CBK has not been able to get the 24 billion that they are offering on a weekly basis. So there's that dip, and it's a function of even liquidity is somehow normalizing as compared to between months of June and July, where there was some outsized liquidity environment that somehow has normalized, and that has also gone into weekly tables performance. In terms of net domestic borrowing, the fiscal year target is around 493 billion, of which, as at the end of last week, we were at 215 billion. So that's roughly 44% of the borrowing throughout this whole financial year ending next June. We said it's ahead of the curve if you look at it that way. And inclusive of the CBK overdraft facility, that's around 213.3 billion. Moving on to the month's primary bond, this was announced last week, whereby CBK, acting as the fiscal agent for National Treasury, is reopening 3 bonds. The part of that bond is the second 15-year paper that was issued in 2010. So it's technically is called FXD2 2010-15. We have also FXD1 2020-15, which is the first 15-year paper that was issued in this year, FXD1 2020-15. And then we have finally the first 20-year paper that was issued in 2011, technically FXD1 2011-20. The target is 50 billion for budgetary support. These papers, because they are more than 10 years tenor, so they are withholding tax of 10%. That's on the coupon. So looking at the terms of those bonds that is remaining, for the first one is 5.3 years. It has a coupon of 9%, offering a coupon of 9%, and implied yield as at the end of last week was 10.39%. So as a rule of thumb again is that if yield is greater than the coupon, it means that the bond is trading at a discount. So this first bond is trading at a discount. Basically, for every 100, the price that you can get right now at the secondary market is below 100. So that's where the trading at a discount comes from. The second one is FXD1 2011-20, which the remaining life on that bond is 10.7 years. It is paying a coupon rate of 10%, and the implied yield is 11.82%. This also is trading at a discount. And finally, FXD1 2020-15, which the remaining life of that bond is 14.5 years. The coupon that is paid is 12.75%, and implied yield is 12.29%. So this one, the implied yield is lower than the coupon. So that means that the bond is trading at a premium. So for every 100 par value, the price that you'll pay as an investor will be higher than 100, 101, 102, whatever price, but it will be higher than 100. So it's trading at a premium. But we shall give an elaborate primary bond recommendation next week, just before the auction on Wednesday next week. And finally, our trading idea is a sale of the infrastructure bond that was offered last year. So infrastructure bond that was offered last month, not last year, last month. So that's IFB1 2020-11. We've seen that slowly this bond is going to start trading at a premium. When it was offered, let me take you back. The coupon for this infrastructure bond is 10.9%, and the yield when it was brought to the primary was around 11.3%. So the bond was at a discount. But right now, as at the end of last week, it was around 11.03%. So it's slowly starting to get into its par value. And at this point, we are seeing that it will become like the other infrastructure bonds, which are trading at a premium. This is the only infrastructure bond that is trading at a discount. As at the end of last week, ideally, it's trading below 100 on average. So, but at some point, it will take a turn, and then it will get into a premium, meaning it's trading above 100. And at that point, investors who have this infrastructure bond might be selling it. So we recommend a sale between 10.8% to 10.85%. Finally, we have our fixed income portfolio performance. Apologies, I was not able to put the equities portfolio performance on this presentation, but it is on our weekly report, and we have our portfolio performance as at the end of last week on a year-to-date basis from January 1st right up until last week. It has a return of 8.53%. And if you compare it with the benchmark is FTSE NSE Kenya Bond Performance Index. That was at 8.26%. So our portfolio slightly outperformed the benchmark by around 0.27%. And in our portfolio, we have the allocation for that. We have a core allocation, which is around 30% of that, comprising of bonds which are less than 5 years to maturity. So we have FXD2 2015-5 and FXD1 2018-5. We have the aggressive allocation, which we look at bonds which pay higher coupons, relatively higher coupons than other bonds. So that allocation is 25.84% of the overall portfolio, and we have 3 bonds there. And finally, we have trading allocation, which is mainly comprising infrastructure bonds. The total portfolio, total allocation as a percentage of the overall portfolio is around 32%. And finally, we have cash, which is 11.8%. But we intend that by the time October comes in, which is a new quarter, we'll have reduced the cash holdings to around 5%. So let me stop it there, and can be any questions. Back to you, Dan.
Thank you very much, Churchill. Now we open the floor for questions. And if you have a question that you want to shoot to Churchill, maybe you can now shoot it right. I've seen Or has raised a hand. Let me just check. Or I have unmuted you. You can maybe speak. Or okay. So for those asking about the presentation will be forwarded to you right after this webinar today. Kevin Safari, I've allowed you to talk. Kindly, you can ask your question.
Good morning, and thank you so much for the good presentation. Am I audible?
Yes, you are.
Okay, thank you. My question is about food. Yeah? This morning, I'm seeing a 4&1 report saying that the Food and Agriculture Organization projects 14.5 million Kenyans are facing a food deficit. And we have about, there's actually a big problem with food, and we actually have another wave of locusts coming in. As Genghis investments, what's your take on the agriculturals, or how can we plug into this? And how come I don't see people like Trigger Foods on the stock exchange? Thank you.
Over to you, Churchill.
Kevin. And it's one of those things that done. Am I audible?
Yes, you are.
Okay, sorry, I think I lost my connection at some point. So thanks, Kevin, for the question. And it's just to answer from the inflation, because it's one of those things. I've seen some comments being put out there that yes, food inflation could be 5%, but it's not relatable. Or as you go to buy, if you go to your local market to buy, you find that the kind of food stuff that you buy might not be represented on the overall CPI basket, the 5%. And that just brings us to the way that food inflation is computed. We find that there's a vegetable component of that. We have meat, we have grains and cereals. So you find cereals and grains is roughly a third of the food inflation. So it tends to be skewed toward that. We have meat, another 16% of that. We have vegetables, another 15% of that. So you find that as the average and the smoothing is done, the end print might not be relatable to even what other people or as you and I might be able to relate with. So that's one. It could be a limiting aspect of the food inflation because it's not comprehensible to compute what each and every person in Kenya is consuming. So just as a commentary to that, and looking at even the threat of locust invasion, yes, in the event that now that food locust invasion goes into the bread basket regions of the country, that is when we can have a significant impact even on the cereals, which accounts for a bigger percentage of the food inflation of that segment, and it will have it will start propelling upwards even in the near future. Just a commentary on the agriculturals. We have 6 counters which are in the agricultural sectors, but most of them are beet tea, think Limuru tea, Williamson tea, Kapchorua tea, we have Sasini, which is a blend, we have Kakuzi, and I think I've forgotten someone, but most of them are biased towards the tea segment and is not representative of even the food inflation thereabout. As Genghis, we don't actively track the agricultural segment, just looking at based on our capacity at the moment, but we'll be happy, but we are usually, we can give bespoke reports to investors who recommend whatever stock bit in the agriculturals. Yes, a question about trigger foods. Yeah, we know that there are some big names out there in the agricultural sector, but they are not listed, and that is something that I think CMA and NSE are actively trying to bring on board. These other big names that are yet to be listed, at least to spur trading in the NSE, because right now, yes, we are around 56 or 58 stocks that are listed, but you find that the investable and securities out of that is quite minimal. It just comes to around 10 or so stocks that trade frequently. So I think there's some robust behind the scenes activities to bring on board some of other names, at least to spur trading at the NSE. Back to you, Dan.
Thank you very much. Kevin Wabungo is asking advice on NMG and KPLC stocks as long-term positions.
Quick answer to that, speculative trading. We don't, we cover KPLC, but we've had speculative trading on that stock as part of our recommendation. But those are usually one-offs. For KPLC, we are skewed towards a sell as opposed to buy, just based on the fundamentals on the company. That's KPLC. In terms of NMG, Nation Media, we don't actively cover the stock, but we are happy. I'll give an elaborate answer to that with once the presentation will be sent out. As right now, I don't have the metrics to comprehensively answer the question that Kevin has brought.
Okay, thank you very much. Any other question, you can forward them through the Q&A and chat question, function, sorry. So other than that, it's almost everyone is asking about the presentation. So the presentation, we're going to share it right after the webinar today. Awar, I allowed, oh, there's a new message. Awar, I allowed you to talk, so you can unmute yourself and maybe share your question. Crispin, you can share your question.
Good morning.
Good morning.
Yes, now it's my first day here, and I'm glad I'm here. The last week session I was unable to attend.
Yes, welcome.
Now I need you people to help me understand this thing like a layman, because it's my first time here and my knowledge for investment in this capital market is almost zero. There is this slide of book closure where we have Kenyan 0.25% dividend. If, for instance, you needed this dividend, what should I do?
A quick answer to that for a layman person like you, Crispin, ideally is now to the book closure date is the final date where investors who want to get that dividend might buy that stock. For example, Jubilee's book closure date is this Friday, 11th of September, paying a dividend of 1 shillings per share, interim dividend, that is. So if you want to get into dividend, if you want to get hold of that dividend, ideally you should have ownership stake in Jubilee. So if you don't have Jubilee in your portfolio, that basically means by July, this Friday is your last day for you to have Jubilee shares in a portfolio that will enable you to receive the dividends once it's paid. So that's the book closure date.
Okay, thank you very much. Timothy Murigi Kingora is asking, what is your advice on Scan Group as a long-term buy?
Thank you, Timothy, and that's a great question. I remember that right after the special dividend that was announced on Scan Group, we saw the stock going upwards to around 22 shillings. And once that special dividend was paid out, that was end of July, if I'm not wrong, we saw that Scan Group has somehow plummeted. It's trading even below 10 shillings per share. So we are still speculative buy on that. We don't have right now, the fundamentals are not telling us that there's a strong buy towards that. So we are biased, or our recommendation is biased towards a speculative buy on Scan Group.
Dennis Rimberia is also asking, what is your take on Kenyan stock? Its income streams are fairly limited, but it seems to be well managed.
Thanks. The question about Kenyan, the biggest risk on Kenyan is that off-taker, it just relies on KPLC to buy its energy. So that's the biggest risk that you flag. Yes, the demand, the fundamentals right now are, we may say that they are quite they are stable. Could be better once COVID-19 is out of the way. And we have seen that there's been a bit of diversifying of their income streams. Last week or 2 weeks ago, there was that collaboration that was announced from Kengen. That said, the dividend payments that was announced full year 2019 results, that's are solid for people who have income investing oriented kind of a strategy, just to get into that income payout that was announced by Kengen. But I can share with you the exact fundamentals once this presentation will be shared out by the marketing team.
And almost lastly, what are your thoughts on Transcentury and Bamburi Cement?
Thanks. Those stocks, we don't actively cover them. On Transcentury, weak fundamentals. Right now, there's a corporate announcement on Transcentury, so it could be out of its way from the NSE market. So our hands are tied in terms of even offering recommendation. Bamburi. Looking at the fundamentals right now in terms of business investment, environment has deteriorated because of COVID-19. So, and just looking at those huge public public investments that was there. The last one is GRFIS one. That really spurred even Bamburi stock here. That said, we don't have a recommendation on Bamburi. Just looking at its the fundamentals on that. Yeah.
And Daniel Mainge is asking, what's your take on TPS Serena?
TPS definitely is bearing the brunt of COVID-19, looking at the whole hospitality industry and the whole ecosystem around that. And so it's even issuing a profit warning for full year 2020 based on that. So in the short term, we are not positive, bullish on TPS arena, but as COVID-19 or that pandemic starts to wear off, that uncertainty, and as the global tourism starts rebounding back, that is the biggest driver that could now propel TPS back to at least to strong fundamentals. But right now, short term, we are less optimistic about TPS, and not only TPS, but the whole hospitality sector, the whole tourism sector.
Okay, thank you very much, Churchill, and all the attendees for coming, for setting part of your time to come and attend this webinar. We value your feedback, and for those who have advised us to include more into our presentation, we are in a process of enriching this presentation so that we give you value for your time that you spend with us. In the coming week, we are going to also Gerald will be back, and we are going to have him back and for him to give us more insights on the equities section. And I think we should end it here. Gerald, do you have Churchill, do you have a parting shot?
Mine is just to thank everyone who joined us this morning. I know it's a chilly morning today. For those people who are coming in from joining in from Nairobi, it's quite a chilly weather, but we just appreciate you for having spared a few minutes this morning to just listen in our thoughts on the trading strategies throughout this week. Much appreciated. Back to you, Dan.
Okay, thank you very much. One last question. Oh, yeah. Margaret Kimani is saying, great insights and keep it up, Team Genghis. On that note, you're going to end it here, and thank you very much for attending.